Okay, let's unpack this. We're doing a deep dive into the investment philosophy that, well, made Warren Buffett one of the wealthiest people on the planet.
Right.
But our mission today isn't just about Buffett. It's about going back to the source,
To the
to
well,
the single document that shaped his entire career.
hmm.
Benjamin Graham's 1949 classic, The Intelligent Investor.
Hmm.
And the value proposition for you, the learner, is pretty simple. Buffett says this book changed his life. He calls it by far the best book on investing ever written.
But he also says it's tough to get through.
Exactly. He admits it's dry, it's a 400-page slog, and a lot of the mechanics are outdated. So we're going to skip that suffering for you.
And just pull out the good stuff.
We're distilling the 19 timeless, actionable rules that you can use right now, whether you're a pro or just managing a 401k.
And what's so fascinating is that the foundation of all this, it's not complex math. It's not algorithms. It's almost entirely behavioral. Buffett always says success in investing has less to do with IQ and more to do with temperament, discipline.
Common sense.
Yeah, exactly. So our focus today is really on those core principles. And the main goal isn't maximizing gains. It's making sure you avoid permanent loss.
Okay, so let's start with the bedrock rules. They sound almost deceptively simple. Rule number 1, never lose money.
And rule number 2, never forget rule number 1.
Right. And if you told a new investor that, they'd laugh at you. Stocks go down all the time, you lose money constantly. What does Buffett actually mean by that?
He's drawing a really, really crucial distinction here. It's between market volatility and the permanent impairment of capital.
Okay, break that down.
Well, short-term price swings, they're going to happen. If a great company's stock drops 20% in a recession, that's just volatility. It'll probably recover.
But a permanent loss is different.
A permanent loss is when the business itself, its ability to make money in the future, has fundamentally collapsed. Think Kodak. Think Blockbuster.
Their earning power was just destroyed.
It's gone. And those losses, they are never coming back.
So how do we guard against that kind of collapse? I mean, even the best analysts can be wrong.
And that's where Graham's most important concept comes in, the margin of safety.
The famous bridge analogy.
That's the one. You build a bridge that can hold 30,000 pounds, but you only ever drive 10,000-pound trucks across it.
Right.
That huge buffer, that safety margin, it's essential. It protects you from two things: market craziness, and more importantly, your own analytical mistakes.
That's the real insight, isn't it? It's admitting you might be wrong.
You will be wrong. So the practical application is this. You figure out what a company is truly worth, its intrinsic value. Let's say it's $100 a share.
Okay.
You don't pay $95. You insist on paying $60, maybe $70.
So that 30 or 40% buffer means that even if you were a bit too optimistic or the economy tanks, you still got a cushion.
Exactly. Buffett made his billions buying dollars for 50 cents. He guaranteed his margin of safety right at the moment he bought in.
And if we buy with that safety margin, we still have to deal with the day-to-day madness. Which brings us to rule 2. Your partner is drunk. Ignore him.
Ah, yes. Mr. Market.
Explain who this guy is.
Okay, imagine your business partner is, let's call him Drunk Dave. And every single day he shows up at your door, he's a total manic depressive.
Okay.
On Monday, he's euphoric, offers to sell you his half of the business for $500. But on Tuesday, he's panicking and wants to buy your half for just $5. The guy has no emotional center.
A rational person knows the actual value of the business didn't change that much overnight.
A rational person completely ignores Drunk Dave's mood swings. You only talk to him when he offers you something truly ridiculous.
Like selling his half for $5.
Or buying your half for $5,000.
Yeah.
If you bought a good business at a good price, you just trust your work. The market, at the end of the day, is just a machine for transferring money from the emotional to the patient.
Okay, but let me push back on that for a second. How is an average person supposed to just ignore Mr. Market when they might need that money in 5 years for a house? Isn't ignoring volatility a luxury?
That's a great question, and it ties right back into the margin of safety.
How so?
If you invest money you need in the short term, you've already violated the rules. You've already violated the rules. You've given up your margin of safety. You are now forced to sell when Drunk Dave is having a panic attack.
So these rules only apply to long-term capital.
They absolutely do. If your time horizon is short, Graham would say your capital needs to be in cash or short-term bonds, not volatile stocks.
That's a perfect transition to how Buffett actually picks these businesses. Let's shift gears to thinking like an owner. Rule 4. Stocks are businesses, not ticker symbols.
This is so simple, but it's where most people just go completely off the rails.
Yeah.
When you buy shares of, say, Microsoft, you're not just buying letters on a screen. You are becoming a tiny business partner with Satya Nadella. And that should demand a certain level of diligence.
Right. And here's the crazy contrast. You'd spend weeks, maybe months, checking the books and counting customers before buying a local pizza shop for 50 grand.
Of course.
But you read one hot tweet, listen to some celebrity, and then just hit buy on $10,000 of stock with basically zero research.
And that's the difference. Business owners get rich by understanding value. Price watchers? They just get broke chasing trends.
So what's the fix?
The fix is to be ruthless about staying within your circle of competence. Only invest in businesses you actually understand, like really understand.
That's the brutal honesty check, right? If you can't explain to a 10-year-old how the company makes money, you just walk away.
You have to. Buffett famously dodged tech stocks for decades. Not because he thought they were bad businesses, but because he didn't get them.
He couldn't predict the winners.
He only bought Apple much, much later when he could clearly see its ecosystem as a durable, predictable business. Knowing what you don't know is your best defense.
Okay, so once we find a business we understand, we have to define its competitive advantage. The economic moat. Rule 5 is about avoiding businesses that are basically just selling a commodity.
Exactly. The moat is that durable, long-term advantage that protects a company's profits, like a castle, surrounded by water.
And there are specific types of moats we can look for.
We can break them down into 3 main categories. First up is production advantages.
Okay.
This could be something complex, like the secret formula for Coca-Cola syrup. It's just incredibly hard to replicate at scale. Or it could be legal protection, like patents or copyrights. Think Disney owning Mickey Mouse. That's a government-protected money printer.
And the second category is more about consumer psychology, right?
Exactly. Consumer advantages. A big one here is high switching costs.
Oh, I feel this one.
You might not pay a fee to change banks, but the hassle, updating direct deposits, automatic payments, it's paralyzing. It locks customers in.
That's definitely why I'm still with my bank from college. The thought of switching everything over is just, a nightmare.
It's incredibly powerful. And then you have the network effect. Think Visa or Facebook. The service becomes more valuable as more people use it. Why join a new social network? All your friends are on the other one.
It's a feedback loop. And what's the third type of moat?
That's brand value. This is what allows Starbucks to charge $5 for coffee. Coffee is a commodity, but the brand promises consistency, a certain experience, and people pay a premium for that. That is a very strong, durable moat.
So we find a wonderful company. It's got a huge moat. Are we done? Is that a guaranteed good return?
Absolutely not. And this brings us to a huge one, Rule 9. Quality doesn't matter if you overpay.
Okay.
If you buy the best company on earth at twice what it's actually worth, you have just destroyed your own margin of safety. The key saying here is it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
That's a bit counterintuitive. Your instinct is to just grab the best thing you can find.
Look at history. In the 1940s, investors were totally right about the future of aviation. They knew airlines would be huge. And most of them still lost money.
Why?
Because they got so excited they piled in at insane prices. The companies did great, but the stocks went nowhere for decades because they were so overvalued. Overpaying for quality is, well, it's financial suicide. It really feels like the biggest fight in investing isn't finding the right company. It's fighting your own brain.
It is 100% a behavioral game.
Yeah.
And nothing illustrates this better than the failure of literally one of the smartest people who ever lived, Isaac Newton.
The guy who figured out gravity.
The genius who calculated planetary motion.
Yeah.
And he got completely wiped out by the market.
It happened.
He was in this South Sea bubble, a huge speculative craze in 1720. He got in, made a nice little profit, and got out. Smart, right?
Both on smart.
But then he watched his friends keep making fortunes. The FOMO, the fear of missing out, it ate him alive. He piled back in right at the very top, and he lost a fortune. His famous quote was, "I can calculate the motions of the heavenly bodies, but not the madness of the people."
Wow. If Isaac Newton can get destroyed by emotion, what chance do the rest of us have?
It just proves it's not about IQ. It's about patience and discipline. Steady equals rich.
And we can actually see the cost of that impatience in the math of Rule 3. Chasing high returns will make you poorer.
This example is wild. Walk us through it.
Okay, imagine 2 friends. Both start with $10,000, invest for 15 years. Friend 1 is boring, aims for a steady 8% year. They end up with about $31,000.
Okay, Pat.
Friend 2 is ambitious, aims for a much better 13% return. But in year 1, there's a panic and they lose 50%.
Ouch.
But then for the next 14 years straight, they hit their goal. They earn 13% every single year.
So they should end up way ahead, right?
They end up with only $27,000, $4,000 behind the boring friend.
Wait, how is that possible? He had a higher return for 14 out of 15 years.
That's the brutal truth of compounding. That one big loss at the beginning just demolishes the engine of growth. You have to get 100% return just to get back to even. It's a hole that's almost impossible to dig out of.
So the lesson is don't try to maximize your returns.
It's to maximize your chances of getting decent returns by avoiding those catastrophic losses.
Which brings us to how we should think about risk. Rule 8. Don't mix gambling with investing.
And Graham gives us a very clear definition. An investment is something that, after thorough analysis, promises safety of your principal and an adequate return. Anything else.
It's speculation.
It's just gambling. And look, we're human. We like the thrill. So his advice is practical. Set aside maybe 10% of your money for fun.
Your play money.
Yeah, trade crypto, chase hot stocks, whatever. But the other 90% has to be boring, real investing. And remember, you don't get paid for being busy. You only get paid for being right.
And speaking of market moods, Graham gives us 2 critical warnings. Rule 14. Buy when everyone else is selling.
Bear markets are just big discount sales on great businesses.
And the flip side, Rule 16. The most dangerous time is when everyone's making easy money.
Oh yeah, when your Uber driver or your barber starts giving you stock tips.
Or when you hear the 4 most dangerous words in investing. This time is different.
That's when you should be very, very careful. Bull markets make people feel like geniuses when really, they're just lucky. The louder the party, the closer it is to being over.
So we've covered the philosophy, the temperament, the analysis. What does this all mean for the average person who doesn't have 60 hours a week for research?
That's rule 6. Pick a side, passive or active. There is no in-between.
So you have 2 choices.
2 good choices. Path 1, you're the lazy investor. You buy boring, low-cost index funds and you never, ever check the prices. Path 2, you're the obsessed investor. This is your full-time job.
And the deadly middle ground is where everybody gets hurt.
That's exactly right. The deadly middle is trying to beat the pros with a few hours of homework on the weekend. It's a recipe for disaster. Buffett's advice is really blunt here.
What is it?
If you spend less than 10 hours a week on research, just stop picking stocks, buy index funds.
Okay, so if we go the passive index fund route, what is the simple, specific strategy he recommends?
It's famously simple, the 90-10 strategy. You put 90% of your long-term money into a low-cost S&P 500 index fund.
And the other 10%.
In short-term government bonds. It's simple, it's cheap, it's diversified, and it's basically a bet on the future of the American economy.
And he proved this works. He won that famous bet against the hedge funds.
A decade-long bet. He proved a simple, cheap index fund would outperform a basket of sophisticated, high-fee hedge funds, and he won. Handily.
And for those of us going the passive route, we should probably be doing this inside things like IRAs or 401ks, right?
Oh, absolutely. The beauty of doing this in a tax-advantaged account is huge. You get the market exposure, and you avoid the headache of capital gains taxes every time the fund rebalances.
It reduces cost and complexity.
Which is everything Buffett is about. Yeah. Simplicity.
And how do we actually implement this strategy to take the most dangerous variable out of the equation, our own emotions?
That's Rule 17. Dollar cost averaging, DCA.
Right.
You just commit to investing the exact same amount of money, say $500, every single month, no matter what the market is doing.
It's automatic.
It completely removes emotion. When prices are high, your $500 buys fewer shares. When the market crashes, that same $500 automatically buys way more shares, which is exactly what you want to be doing. You average out to a great price over time without ever trying to time the market.
Which is a fool's game.
The ultimate fool's game.
We've talked about all these rules for investing, but Buffett's single most important piece of financial advice has nothing to do with stocks.
Yeah, if we zoom out to just building real wealth, the punchline is this. You must pay off all high-interest credit card debt before you invest a single dollar.
The math on this is just staggering.
Let's say you have $5,000 in credit card debt at a 20% APR. That is a guaranteed hole in your financial boat.
A guaranteed loss.
Over 5 years, that debt will cost you over $8,500 in interest alone. Now, compare that to investing that same 5 grand. If you get the historical 10% market return, you'd only make about $3,000.
So paying off the debt is a guaranteed risk-free return of 20%.
It is an unbeatable deal. It is the single best investment anyone can possibly make.
So what does this all mean for you, the listener? The road to wealth, based on everything Graham and Buffett taught us, isn't paved with brilliance.
No, it's paved with extraordinary discipline, patience, and just simplicity.
It's about focusing on what you keep, not just what you make.
And that focus extends to your whole financial life. Reinvest your earnings. That's what Buffett did with his first pinball machine. He just used the profits to buy another one, compounding from day one. And Rule 19, track your net worth, not your salary.
Why is that so important?
Because wealth is what you keep. Tracking your net worth holds you accountable for debt and spending. It keeps you from earning a huge salary but having nothing to show for it.
So as we wrap up this deep dive, let's leave you with one final thought. It's about volatility and Rule 18. We all think the stock market is scary because prices bounce around.
Right. It feels risky.
But let's think about cash. Cash feels safe. The number in your bank account doesn't change day to day.
But it's an illusion. Because of inflation, cash guarantees you a loss. It shrinks quietly every single day while you sleep.
Stocks are risky because they bounce. They might go down.
But cash is arguably riskier because it shrinks every single day, guaranteed. It is a slow, silent, permanent impairment of your capital.
So the question you need to ask yourself isn't whether you will lose money in stocks. It's how much you are already losing right now by hiding in a currency that is designed to shrink. It just reinforces the need for action and for owning assets for the long term, all while protected by Graham's margin of safety.